Hello, my favorite realtor partners. Hope you're having a fantastic day. God, we had a crazy end of the week last week. We're going to talk about that in the markets in just a few minutes. We also have great news on interest rates today, and I want to talk about part 5 of the 10 realtor laws. So, the 10 realtor laws were created by the core training and the realtor coaches. In order to be a level 3 realtor coach, you have to make $1 million a year net, and you have to have $1 million in the bank. So, these are top producers, and they practice this every day, and that's why I'm sharing it with you. So number 5 is giving great gifts. So we give cheesy gifts to our past clients. These are to anyone that any past clients that have referred you business before. A cheesy gift would be considered a keychain, hats, maybe some cool golf balls with your logo on it, a wine opener, a cell phone charger, just something to show them that you're thinking about them and you're touching them, and they know that you think of them as a great client. So that's cheesy gifts for your past clients. We have an amazing birthday program for Sphere of Influence and VIPs. We have 3 different levels for this program. So level A would be a VIP or a Sphere of Influence that has referred you multiple deals and that have also closed with you on multiple deals. That's a $100 gift for their birthday every single year. Level B would be a VIP or Sphere of Influence that has done a deal with you, at least one, and then has referred you at least one deal, and that would be a $50 birthday card. I'm sorry, birthday gift every year. And then level C would be a VIP or a Sphere of Influence that has closed a deal with you, or they have referred a deal to you, and that's a $25 gift card. I'm sorry, gift, not gift card, for their birthday every single year. So it's a great program, great way to keep in touch with them and show them your love. We do great personalized closing gifts. So we do an all about you form. I can send that to you if you don't have it already. And we have them fill out this form. So that way it's a beautiful personalized closing gift for your clients on closing day. And then we love pizza on moved in day. So if you're not going to do a closing gift, then pizza is a great idea. Help them feed them while they're moving that day. And last, but make sure to give gifts on milestones. So these major milestones would be a job promotion. So, we talked about birthdays already, anniversaries, or a wedding, something big in your clients or your past clients or sphere of influence lives that is something worth noting. So make sure that you are gifting well, and call me if you have any questions about that. Now let's talk about the jobs report and then what happened with the banking system over the last couple of days. So both of these, the jobs report and also the banking system, have negative impact on the economy and what's going on in the markets, which is actually really good for rates. So that's why we've seen interest rates improve by about 0.5% over the last 2 days. So I'm going to share my screen with you and show you the little crack that we have in the jobs report. So this is February's jobs report for 2023. As you can see at first glance, we actually beat estimates. There are supposed to be 225,000 jobs created. Actually, we're 311. But then if you start diving into it, you can see that the past 2 months have a negative $34,000 adjustment. So that's crack 1. The second crack, which is, I think, very important to see, is that there's been a big jump in the duration of unemployment. So we've seen a $343,000 jump in this number of people being unemployed for less than 5 weeks. And so because of this jump, we're going to see a more unemployment, or I guess worse unemployment numbers in the future. We also saw the unemployment rate increase by 0.2%. So we're starting to see that all of this pain that the Federal Reserve is causing by higher rates is starting to affect the job market a little bit. And so that is good for interest rates. The second thing that happened that is been a shock to a lot of people, you probably heard it on the news, reading about it, but a Silicon Valley Bank ended up having to be shut down and taken over by the FDIC. This was caused primarily because of what's happening with the Federal Reserve increasing interest rates faster and harder than we needed them to be. They should have done this in 2021 when interest rates are the lowest that they ever were, and they should have started increasing interest rates then. We had a strong housing market back then. We have a really strong market right now, and rates are much higher than they were back then. So the government and the Federal Reserve just waited too long to increase rates, and now they're increasing rates too fast, and it's causing stress on the banking industry. The reason why is because we have what's called right now an inverted yield curve. So interest rates for short-term loans are actually higher than interest rates for long-term. And so right now, the way that a bank works is that banks, they take deposits from us depositors, and then they give us a small return on that deposit. Then they take the remaining money and they invest in higher interest rate, longer term investments. Okay. So over the last 6 months, because of interest rates going up, these long term investments that are locked in have now lost value. And so now they're worth less than what they were 6 or 12 months ago. And then they also have to pay us a higher interest rate on our deposits, and that's taken away from the spread that they're making between what they take in and what they lend out. So now they have this double whammy where they're not making any money on the deposits that we're sending us because they're paying us a high interest rate, and they're not getting a high interest rate back, or not that spread that they wanted. And then also those longer term interest investments are losing money. So what happens is when that news comes out, this is what happened with Silicon Valley Bank, all of a sudden you had some of the depositors starting to pull money out because they're starting to see that this is not a very strong bank. And then when one person starts taking it out, other people start seeing and hearing about it. All of a sudden it's called a run on the banks. Well, then if people are asking for too much money back, the bank doesn't have all that money. So they have to stop and be taken over by the FDIC so that the federal banking system can take over and make everybody whole. Now, by this happening, it has caused a lot of fear in our banking system. And the Federal Reserve has come in and sort of taken away that fear by not only backing the $250,000 that the FDIC has insured, but now they're backing all deposits from these banks. And so it's showing that we have a systematic problem due to the Federal Reserve increasing rates too fast, too hard, and the banking system not being able to handle it. Now, why this is good for interest rates is because when this happens, it shows the Federal Reserve that I think we need to slow down a little bit. I think we're good. Okay. And so what we're going to do, what we're going to see is because of what's happened over the last couple of days, we're probably going to see the Federal Reserve not only stop increasing rates, but we may end up seeing them start lowering rates if this continues. So I feel like this is a great opportunity to, when bad news comes out, it's usually great for interest rates for us to go to our clients and say, hey, interest rates are 0.5% lower than they were last week. Let's get out there and start looking for homes. Let's get out there and start making moves because these rates could change at any point in time. And let's get locked in when we can, when rates are low. So give me a call if you have any questions about this. I know it's a lot of information. You can reach me at 847-942-1497. Talk to you soon.